Welcome to Nasdaq TradeTalks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me for this segment, we have Dave Mazza, Chief Strategy Officer at Roundhill Investments, to discuss navigating the current market environment with the new defensive. Dave, it's great to see you as always. Welcome back to Trade Talks.
Thanks for having me back.
All right, you got it. Before we get into your sector positioning, what is your thoughts on the overall macro environment and certain levels that we need to be aware of in the S&P?
Yeah, no, great point. So I think we've been in a confusing economic environment. I've characterized it as something for everything. You can look at jobs data 1 month, looks great. Look at PCE, CPI next month, looks bad. But net, we know that the Federal Reserve has been raising interest rates in a slowing economic environment. Generally, things break. We've been in a rolling recession, I think, now for some time. We haven't seen the big bang moment. But more recently, I think the S&P 500 and other major indices, including some major companies, have dipped below key levels, whether it's 50-day moving averages, 200-day. And now more recently, when we saw the S&P breach that 4,200 level, which many traders were really anchored on, it begins to get a little bit more challenging below because the support just isn't there.
Let's talk about it from a sector perspective, because what you would think would perform well in a higher interest rate environment isn't necessarily holding up, and you're looking towards the new defensive. So explain to us what's not working and why, and some areas where you think we should be looking at.
Yeah, look, a lot of people have focused on this year with the Magnificent Seven and the concentration that we've seen in S&P 500, Nasdaq, other indices. But usually when people get concerned, they get defensive. In the old school defensives, utilities, healthcare, consumer staples, they just haven't worked. And they haven't worked because they have a lot of interest rate risk with them, associated with them, excuse me, even though these companies actually pay high dividend yields and can be attractive and historically have worked. But this year, folks have actually turned to areas where companies are producing revenue and producing earnings, and actually where there's more clarity of that, what that earnings picture looks like going forward. So if you're concerned about a pullback in the consumer, even staples, which tend to be companies, producing revenues that folks need to buy even in recessions, haven't done well because they have a lot of leverage associated with them.
So it's interesting, you mentioned before that you're worried about the concentration with the Magnificent Seven and the risk that could have to the major indices. But to your point, they are performing well. Their earnings are growing. They're growing revenue, which is always a key, regardless of the interest rate environment. So how would investors get exposure to this utilizing an ETF?
Yeah, so because these names are so large, they're the largest, most liquid securities really in the globe. And I'm talking specifically about big tech and now the Magnificent Seven. There's a lot of opportunities for them. But what hasn't existed until today is an ETF with dedicated and only exposure to the Magnificent Seven stocks. And you can find that with our Big T ETF. The ticker is BIGT. That's traded on the Nasdaq. And it's an opportunity for investors and traders who want that precise exposure to just those 7 names without watered down exposure to anything else that's available to them now. So for folks who are looking for opportunities of where companies have grown their earnings and may continue to grow in a uncertain market environment, folks can look toward Big T to be that tool for them.
So Dave, what's the methodology behind that then? Are you actively trading in and out of that, or is it just balanced in such a way where it's equal exposure and it's up to the investor to figure out how much they want to dial up or down the exposure to those names?
Yeah, so within Big T, it's actually equal weighted exposure to those 7 names. So on a quarterly basis, we'll rebalance the portfolio back to equal weight so that not one security can influence either too positively or too negatively. And the interesting thing is, we've heard some folks come to us and say, hey, it's just 7 names. I can buy them on our own, or I'll pick my favorite. And that, if you have the ability to monitor your positions, certainly that could be an opportunity for you. But I think we know with behavioral biases, it can get the better of us. Even if we think we're going to rebalance on a frequent basis, it can be hard to do so. On an ETF, particularly one package like Big T, can be that for them.
All right, Dave, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.